Hello and welcome to the second video in this day trading course, Basics of Stocks, Options, and Futures. When it comes to trading, it is important that you completely understand what it is you are trading and the different risk and reward characteristics of each asset. Before we get started, I just want to give a quick disclaimer that everything that I talk about in this video, plus all the material provided on Discord and in the private trading room, is for educational purposes only. Nothing should be considered financial advice. Also, make sure you guys are aware of the risks when it comes to trading in financial markets, especially when it comes to trading highly volatile assets like futures and options. With trading, you have the ability to earn high returns, but there is also a high level of risk and you can blow your account. So please make sure you guys are aware of that and please do your own due diligence. In today's video, we will be talking a little bit about the risks of these assets, but I've also uploaded a file in the disclaimer channel of our Discord where you can read and fully understand the risk and reward of trading options and futures. Okay, so let's begin. Financial markets contain a wide variety of assets that are available to investors. These assets can be generally compared using their risk and reward characteristics. It is a common rule of thumb that there is a risk-reward trade-off. Generally, the riskier an asset is, the higher the potential for returns. Starting off at the lowest level of risk, we have savings accounts, GICs, and some bonds. These investments guarantee a return on your principal investment plus interest, so they are the safest investments, but the return potential isn't very high. These types of investments are generalized as fixed income securities. We then have mutual funds, ETFs, and stocks. These are well known as equity investments and carry a high level of risk since, unlike fixed income securities, your principal investment is not guaranteed. Therefore, unless you are borrowing to fund your investments, the max loss is your invested capital. Generally, mutual funds and ETFs are safer than stocks since they are a portfolio of stocks used to represent a particular market, industry, sector, etc. But they generally have higher management fees as well. Next up, we then have futures and option contracts known as derivatives. Derivatives are contracts that derive their value from an underlying asset. These contracts are highly leveraged assets and are extremely volatile. Initially, they were created to be used as a hedging vehicle to reduce risk. However, now these derivatives are used for speculative trading. Options and futures trading can result in exponential gains, but since they are extremely volatile, you can blow your account in a matter of seconds as well. So please be aware of the complete risks of trading these assets by reading the disclosure in the disclaimer channel of our Discord. The highest level of risk is crypto. To be honest, I don't know much about crypto and I don't trade it myself, but it is an extremely volatile and high risk asset, so please make sure you do your due diligence before looking to invest in crypto stocks and crypto itself. Alright, so the first asset I will begin with is the most commonly traded investment, which is stocks. Stocks or shares represent ownership stake in a company. So essentially, when you purchase a share, you are purchasing ownership interest of that company. Shares can have a lot of unique characteristics such as voting rights and dividends, and initially companies will issue shares on public exchanges through what's called an initial public offering or IPO. They will do this to receive cash in order to fund future operations, undergo research and development, or to pay off their previously owed debt. After the IPO, the company then has a certain number of shares outstanding in the markets that then gets traded between traders in the secondary market. The secondary market includes traders like institutions, like banks, that will purchase shares to hold in portfolios and ETFs, and then market those portfolios as part of retirement packages for the average investors. Then there's retail traders that will then purchase selling shares amongst each other for profits and quick gains. Stocks generally offer two types of returns. The first return is in the form of capital appreciation, which is the gain or loss in the share's value from the moment of purchase to its close. This is an easy concept to grasp. Purchase a stock for $5, sell it for $10, boom, you made $5 per share. The profits you make from buying and selling shares is referred to as capital gains and is taxed at 50%. There are several tax considerations to take when purchasing and selling shares, so please make sure you seek advice from your accountant or financial advisor. If the stock price were to go down, it would result in a capital loss, which can then be used to offset that gain, but again, speak to an advisor before going any tax planning routes. The second type of return that you can make from stocks is in the form of dividends. Sometimes when companies make excess profits, they will pay out those returns to shareholders in the form of dividends. Stock investors have limited liability, which means that you can only lose what you've invested. So if you purchase a stock and then the stock goes to zero, you will lose your entire capital investment. which is why stock trading can be a lot riskier than GICs and bonds where the principal investment is guaranteed. It is important to consider the risks that can affect a stock's price, such as market risk, company risk, and economic risk. As day traders, we're not too much concerned with these risks since we're only trying to profit on quick changes in price. However, if you are fundamental analysis or want to hold stocks as part of your portfolio, then these risks should be considered before purchasing the stock. Stocks trade on exchange markets like the TSX, the New York Stock Exchange, and the NASDAQ, and we traders can access these markets through what's called brokerages. There are several online brokers available like Interactive Brokers, Questrade, Wealthsimple, TD Ameritrade, etc. And we'll discuss these brokers and financial market structure in the next video. So different types of stocks can be characterized based on similarities. Generally, the most four common groups of types of stocks includes blue chip stocks, income stocks, growth stocks, and value stocks. Blue chip stocks are large, well-established companies with stable earnings and strong track records, and these companies are industry leaders and are seen as less riskier stocks. Income stocks are companies where their shares pay regular dividends out to their shareholders. These are generally mature companies with established cash flows. There are then growth stocks, which are companies that have higher than average growth in revenue and earnings and invest heavily in research and development and future investments. And then lastly, value stocks, which are companies that investors consider undervalued based on their estimations using financial models and formulas. There are other ways to group stocks, such as their industry as well, such as by industry. Alright, so next I also want to discuss is the major stock indices. Indices are a portfolio of stocks that are grouped together to represent an industry or to represent a market segment. The price for these indices is calculated using a weighted average formula of its holdings, and the three major indices that you will largely hear about when determining sort of the overall health of the market is the S&P 500, the NASDAQ 100, and the Dow Jones 30. The S&P 500 includes the 500 largest publicly traded companies across all industries. The NASDAQ 100 contains the top 100 companies that trade on the NASDAQ exchange, which includes primarily tech companies and thus is more volatile in price than the S&P. And then lastly, we have the Dow 30, which is just the 30 largest companies. These indices don't trade on markets, and the price is determined using financial calculations and the weighted average of the holdings in a portfolio. However, financial institutions have created portfolios sort of that mimic these indices, and these portfolios do trade on markets and are known as ETFs. For the S&P 500, which can also be known as SPX, the major ETF that is traded on markets between traders is called the SPY. For NASDAQ, it's the triple Qs, the QQQ, and these ETFs are actively traded in markets, and the derivatives such as options are also traded heavily for these assets as well. Alright, so next we're going to talk about options. Options are contracts where the buyer pays a premium to the seller for the right to either purchase or sell a stock at a specified price by a future expiry date. So it's important to understand that options are contracts, so they could be privately negotiated contracts between a buyer and a seller, or they could be publicly standardized contracts that get traded on public exchanges between traders. Options were initially created as a hedging instrument since corporations could then guarantee the price at which they would purchase or sell stocks for a premium price. But with the rise of technology and popularity, options have now become an asset that is used by day traders for speculative trading to quickly gain from changes in the premium price. Essentially, there are two types of options. There are call options and then there are put options. Call options gives the buyer the right to purchase the stock, and put options gives them the right to sell the stock. The purchase or sell price is known as the option's strike price. Every option also has an expiry date. After this date, the buyer no longer has the right to purchase or sell the stock at that strike price, so the option's value or premium then drops to zero. At expiry, the holder of the contract can choose to exercise the contract, where they will then have to purchase or sell the underlying asset at its strike price. The goal with day trading, however, is never to exercise, but always to profit from the quick gains and changes in the premium price for that option contract. So essentially then, what affects an options premium? Well, the first thing that affects option premium is the price of the underlying. So for example, let's just say we have a call option with a $50 strike price and we paid a premium for $1.50. It's also important to note that for option, when you guys see call options and put options on the market, the premium is listed as like $1.50 or it'll be like 60 cents and stuff like that. It's important that you times this by 100 to find out the true price you're paying. So when you see a $50 strike call option with a premium of $1.50, you're actually paying $150. All right. So back to this example. So let's say you have a stock, right? And you buy a call option for that stock with a $50 strike price. And the current market price for that stock is now at $45. So this means that someone in the market could actually just pay a cheaper price in the market and get that stock rather than having to pay a premium to pay a higher price, right? Because if the call option gives you the right to purchase a stock. So why would you want to pay a higher premium if the current market price is lower? This will make our call option out of the money and our potential profits be zero, right? So now let's say the market price then goes up to $50. Well, now this is equal to our strike price. So again, why would someone pay a premium if they could just right buy it for the same price in the market currently? So this is referred to as at the money, and our profit will still be zero. So now let's say the market price for the stock goes up to $55. Well, now our call option gives the option for someone to buy the stock at a cheaper price than what it currently is in the market. Therefore, our call option would be in the money, and we can earn a max profit of $5, which is the difference between the strike price and the current market price. However, this is just the max potential profit, okay? There's a lot of other things that go into that affects the option premium, and you'll never receive the max potential, and it will always be slightly different. In the next example, let's go over a put option example. So a put option again gives you the right to sell a stock. So let's say we buy a put option with the $50 strike price. So it's giving us the option to sell the stock at $50, right? And we paid a premium for $1.50. So let's say the current market price is now $45. So now this is giving you the option to sell at a cheaper price than what you have. So your option will be in the money, because if someone can exercise your option and sell at a higher price and make more profits. So with the price at $45, our put option would be in the money, and we have the max potential profit of $5, right? So again, if the price now market price of the stock is $50, our put option is at a $50 strike price, we will be at the money and potential profit is zero. And let's say now the price is at $55. Well, the price in the market is higher than our current strike price for our put option. So someone can actually sell for higher in the market currently. So why would they buy our put option? And it would be out of the money, and our max potential profit is zero. Just a basic summary: if you buy a call option, the premium goes up with the stock price, and if you buy a put option, the premium goes up when the stock price goes down. So it goes inverse with stock price. It is important to note that option contracts are highly leveraged assets and were initially created as hedging instruments to protect against the volatile movements in stocks. So essentially, the more volatile the underlying stock is, then the higher the option premium for the stock will be. So that's why you see higher premiums for volatile stocks like Tesla and Nvidia, while you don't see it so much for less volatile stocks like bank stocks or utility stocks. All right. So essentially, when you trade options, you want to focus on stocks with high volatility, and this can be sector focused like tech stocks. You can focus on large price swings if there's a lot of speculative action going on because of economic or company related events, and you also want to look at the trading value from the stock as well. Okay. Besides implied volatility, another important concept to option contracts is the expiry date. When contract hits the expiry date, it is worth $0 because you no longer have the right, and there's no longer any value in your option contract. So the more time you have until expiry, the higher the option premium will be. But the closer you get to expiry, the faster the value of that option will decay. And this phenomenon is known as time decay. With options, there is a growing popularity of trading what's called SPX 0-day TEs. SPX, again, previously explained in this video, is an index. So a lot of people will buy call and put options based off of this index as a way to trade it, right? And with the rise of options trading, the financial institutions have initiated a sort of contract where you could buy a call and option that expires in the same day. This contract has grown in popularity to be traded by day traders, but it is important to note that it is very highly risky because of this time decay phenomenon. So because the closer you get to the end of the day, which is 4 p.m. for option contracts, the faster the value of time decay hits, and the faster you can lose value when trading these contracts. So if you ever do want to trade SPX 0-day TEs, just go in with the precognition that you can lose your entire investment very quickly. Okay. So the last asset class that I want to talk about is futures contracts. So essentially, a futures contract is a contract where the buyer agrees to purchase an underlying asset from the seller at a later date at a fixed price that they agreed to when the contract is signed. So essentially, the buyer is locking in a price today that they then must pay in the future, and the seller has to guarantee the sale in the future at that price. This is when there is a privately negotiated contract between a buyer and a seller. It is what's referred to as a forward contract. However, when the contract is standardized and trades on public exchanges available to secondary markets and retail traders, it is known as a futures contract. With a futures contract, there's a daily settlement of gains and losses, and it can trade on public exchanges. Futures can essentially derive their value from common commodities such as oil. They can do it from metals such as gold, and indices such as like the S&P 500 and the NASDAQ. The difference in the price between the futures contract and the underlying asset price is primarily due to the added time benefit in holding the futures contract. That's why these contracts will always be priced higher than the current price of the underlying, and as it gets closer to the expiry, the prices will converge into one. Day traders benefit from the price appreciation in the futures contract price, and to know the maximum amount earned per contract in the most commonly traded assets, I've included them in this presentation. However, you can also find it in the futures cheat sheet in the educational channel of this Discord. Alright, that concludes this video about the different assets that are available for you to trade. In the next video, we will talk about the ways on how you can connect to the stock market to submit buy and sell orders. If you guys want to go over the basics of these assets, just make sure to watch this video again. There are also cheat sheets available in the educational channel of the Discord, and you can always ask questions by DMing me on Discord as well. Alright guys, see you in the next video.